Hi guys, how's it going? Juan Ortiz, your friend, your lender. How are you doing this week? It is December. It is the end of the year. I can't believe it. Time just flew by. I want to tell you guys or talk to you guys about refinancing from a 30-year loan to a 20-year loan and to a 10-year loan. Most people just think about a refinance from going to a 30 to a 30, and a lot of times it doesn't make sense because the interest rate doesn't change enough. But once you start doing the mathematics and once you start seeing how many years you can save on the mortgage, I think it changes a bit. So I'm going to show you three examples of mortgage payments. Someone who's paying a loan on a 30-year loan, a 20-year loan, and a 10-year loan, and it makes a big difference. But I must tell you, the numbers that I'm using here are very as an example. I'm going to give you an example of a loan amount. And I'm also going to give you an example of an interest rate for a 30-year fix, a 20-year, and a 15-year. This is not exact numbers. And I must tell you this because legally I must tell you this. So I want you to know, if you really want me to tell you your specific situation, I can look into it. I can give you exact interest rates. I can tell you exactly what the costs are associated with your specific situation. So these situations here are very example type of situations, but real situations, very real, but it's an example. So let me start with a 30-year loan. If you do a 30-year loan, and hopefully I'm not in your way, a 30-year loan based on a $300,000, let's say, loan amount on a 30-year, if you have an interest rate of 5%, your principal and interest is $1,610. That's $1,610 per month. That's what you're paying towards the principal and interest, not to mention taxes and insurance. Now, if when you originated this loan, if it was an FHA loan, then we have what's called the mortgage insurance. That mortgage insurance is usually going to run you about $325 per month based on a $300,000 loan. If you do have a $300,000 loan and it's 30-year fixed and it's $1,610 for principal and interest, and your mortgage insurance is $325, then your payment's going to be about $1,935. Principal, interest, and mortgage insurance. We're not talking about taxes or fire insurance. $1,935. Now that's a 30-year loan. You know, this is your traditional 30-year. If it's just a 30-year conventional loan on $300,000, you're paying $1,610 and for principal and interest. But if it's an FHA loan, you're paying $1,935 for principal, interest, and mortgage insurance, excluding the fire insurance and taxes. Now, on a 20-year loan, if you come out to a 20-year loan, now basically 20-year loans and 15-year loans, most of the time, 90% of the time or something, these loans are conventional loans. So I'm not going to talk about FHA whatsoever. If you do this same loan with a 20-year fixed loan, $300,000 loan, just to make the comparison exactly, we switch the rate like a whole percent down. You go from like a 5% to a 4%. Your principal and interest payment is going to be $1,817. The difference between $1,817 and $1,610, that means that your payment is going to go up about $200, something like that. But you know what? You are cutting 10 years off the loan. If you do not pay 10 years off the loan and you multiply 1610 times 12 and then times 10 years, you will be saving $193,200. That's almost $200,000 that you'll save if you go from a 30-year to a 20-year. That's unreal. And I know that sometimes it seems like it's so far away, but it's not. So 30-year to a 20-year makes a lot of sense. Now, a lot of us will also want the 15-year. If you go to a 15-year and we put the interest rate even a little lower at 3.5, then your mortgage payment goes up to $2,144 for principal and interest, and it's a 15-year loan. You cut 15 years, and you will save about $289,800 in 15 years worth of payments. Of course, that your monthly payments will slightly increase if when you're making these adjustments. But I want you to think about this. If you are already on an FHA loan and you're paying for mortgage insurance, your mortgage insurance payment is $1,935 right now on this scenario. If you jump to a 20-year loan, it's actually going to drop your monthly payment. Now, if you go from this FHA loan to a 15-year loan, the difference is minimal. We're talking about less than $200, somewhere around there. So I hope I'm not confusing you. I hope that you can follow me. But if this intrigues you, if you think that you want to learn a little bit more about this, I'm your guy. I can help you with this. We can play around with the numbers. We can see if we can cut some years off your mortgage. 30 years, 20 years, 15 years, 20 years, we got them all. So don't just think interest rate. Think about, can I make this mortgage finish sooner? Call me, Juan Ortiz, your friend, your lender. I hope you're safe. I hope you're staying dry. Thank you very much. See ya.